Hello and welcome to Portfolio Matters Share Talk. Today we will be discussing the London listed oil services company Hunting PLC. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Over to you, Keith.
Thank you, Richard. Now, this is the second, or actually the third oil services company we have covered. So I hope you have watched the share talks on Entech, which we liked, Petrofac, which we thought was a very poor quality company, but might be a speculation. And now we are covering Hunting, which I like, and I think is a very high quality company. So Hunting are a British oil services company, which mainly specializes in high-end downhole drilling bits, but also has other divisions such as subsea and engineering, and it has continued to invest in the technology through the cycle. This is the share price, and you can see that in 2018, towards the peak of the last oil cycle, the shares were above £9, and you can now have them for about £2.40. So as the oil price ticks up and drilling returns, hopefully the share price of Hunting will follow it. So now actually this morning share price of Hunting is about £2.50, but market cap about 400 million. It's got net cash. Revenue forecast for 2020 is 630 million. It actually paid a dividend last year. And I really like this company. I've bought some, and I think it is a good quality with a good margin drilling technology company. And it should benefit from the recovery in oil markets. So its largest division, the one that it's most famous for, is Titan, which it bought a few years ago and was originally a US downhole drilling technology company, which specializes in downhole bits for the shale oil industry, including perforating guns. And if you go onto their website, you'll see lots of exciting videos of these guns going off with lots of high explosives, making lots of nice noise. It's great. But it has continued to invest in other areas. So this is an acquisition it made last year during the down cycle in the oil industry, a company called Enpro Subsea, which makes these down subsea specialist infrastructure. Enpro Subsea was named 2020 Company of the Year by the Subsea UK. It had 2019 revenues of 14.1 million and EBITDA of 3.4. And this makes Hunting a diverse oil services company. And this is another acquisition it made in 2019. And this is a company that specializes in large titanium structures. So this picture is of a titanium stress joint. You can see bottom left here how titanium stress joints are 76% shorter, 63% thinner, and 79% more flexible than steel ones. So it's creating this conglomerate of specialist engineering companies that are exposed to the oil sector. And it's continually innovating. So if you look on the website, there's always some new technology that they are pushing. And one of the things that caught my eye was this organic oil recovery. So what they do is they actually inject bacteria into old oil wells, and the bacteria essentially emulsify the oil, which allows it to be extracted. So it stops it, takes it away from sticking to the rock and allows it to come out with the water flow. And they've trialed this in the North Sea. So what they did was they injected a load of this bacteria together with nutrients, shut in the well for 7 days to allow it to digest the oil, and then added some more nutrient and shut it in again for another 3 days, and then returned the field to production. And the results were very good. 1,000% return on investment, 250,000 plus incremental production in barrels of oil per day, 4% drop in the water cut, and the investment paid itself back in a week. And this is the sort of stuff that Hunting does. I find it very interesting.
Impressive.
Yeah, so in 2020, it restructured, as I think most of these oil companies did, because of the falling oil price. So it reduced the headcount by 30%, closed 2 manufacturing facilities and its loss-making Canadian manufacturing facility, and will now supply the Canadian market from the US. Closed 4 distribution centers, amalgamated its Singapore facilities, cut the capex budget by 50%, and made annualized savings of 70 million. So it's emerging, restructured and leaner. And these are the H1 2020 results, and you can see that obviously revenues are down, but in a good year, and frankly 2019 wasn't even a terribly good year for the oil market. It makes decent gross margins, 30%, 29%. So I like this company. We looked at Petrofac and it had margins like 6% to 8%. This has got decent margins. And in the worst oil market in living memory, it made a profit, albeit a tiny one. Now, if you look at the segmental market results by segment, you'll see the US still dominates. They are trying to diversify away from the US, but the company is still actually heavily dependent on US shale, which remains depressed.
Keith, can I?
Sure.
If US shale doesn't come back to the levels it was before, what happens to Hunting and their revenue?
It will never regain the peaks it had, but you'll see it's diversified into subsea. Drilling will pick up around the world, but what is great for Hunting is that shale oil has very high decline rates, so you need to keep on drilling. Now, around the world, they're drilling traditional oil wells, and you don't need to drill that many of them. The great thing for Hunting was the US shale. You're drilling lots and lots of wells continually. Now, the thing is, as the oil price ticks up, there are a lot of shale oil wells you could drill. And my strong suspicion is that all the capital discipline that the US shale well operators are now talking about will disappear when oil prices are high. And I think Hunting will do well. You'll see from this revenue by division, most of its money comes from OCTG, which is sadly not very high-tech stuff. Oil country tubular goods are basically pipes you stick down the well, and frankly I just don't think that's very high margin. High margin stuff will be the tech stuff like perforating guns and advanced manufacturing. But you'll see that tubing, its sales held up very well, and that's the cheap stuff. But the subsea is growing, and in a bad year. So that's the Enpro acquisition, and you'd hope going forwards that will be a good addition to the product mix. Now, if we look at the cash flow, there was quite a big cash outflow last year, but actually when you dig into it, majority of that was reduction in trade creditors, the Enpro acquisition, which was made in cash, and it continued to pay dividends and buy back shares. So if you take away all that, it was probably about flat. Now, when you look at the operational overview, it makes a big play about TechLock, significant growth in TechLock. So what's TechLock? And this is showing, how TechLock volumes have grown in a declining market. So they're taking market share from everyone. Unfortunately, TechLock turns out to be a very low-tech piece of kit. So it's something that joins downhole pipes together seamlessly. And, I'm sure it's essential, but it's I can't imagine this is terribly either expensive or a high margin. But anyway, they're a growing market in it. Offshore markets are depressed. In fact, the whole US oil sector everywhere is depressed. But they also have this advanced manufacturing group, which specializes in coatings and hardenings. And this is non-oil. A part of it is non-oil. So 25% of it goes to the medical industry. And they also supply defense and aerospace. And that's advanced manufacturing is 15% of revenues. So I really like this company. It's, specializes in high technology, good quality products. And it is, as we discussed, the Enpro acquisition increases the services it can offer subsea. But as Richard asked, it is heavily exposed to US shale, and the reality is the US rig count is way lower than it was, 7 or 8 years ago. It's ticking up, but will it ever get back to the levels of 2013, 2014? Frankly, I doubt it. I think the levels of 3 or 4 years ago are more plausible. And to add to that, if these are the results, and you'll see that the glory days of Hunting were when everyone was drilling lots of wells, shale oil wells, back in 2013, 2014. And, one way to look at this company is that over the last 7 years, if you look at forecast 2020 earnings, they are less than half of what they were in 2014. But the share price is also a fraction of what it was back in 2014, and the oil market is recovering, and oil prices have risen strongly. And it has a decent gross profit margins, which I expect to recover, and it's restructured. And it's got net cash and no debt, pays dividend. So positives: net cash, strong balance sheet. It's an innovative technology company specializing in the oil industry. I like this company. It was EBITDA positive in H1 2020, which is the worst oil market ever. And during 2020, it did this restructuring program that saved 70 million per annum. And I think it's just well placed for an oil market recovery. Downsides are it specializes in basically downhole drilling bits, and the market that most needs downhole drilling is US shale, and that is depressed. And the US shale industry is making a big thing about having capital discipline going forwards and not drilling everything in sight. And frankly, my purchase of Hunting is partly a bet on that their self-discipline will collapse, as it always has done. Also, it's an oil company. It's heavily exposed to the oil company, and therefore, if it is exposed to the energy transition, if oil disappears quickly, then it won't do well. No, that's it really. I think I really like this company. I bought a load. I think of the oil services companies we've covered. So Entech is interesting, speculative, but tiny. Petrofac was low quality, but had a bombed out share price and frankly a dangerous share. And this is good quality.
Good.
I like it.
Thank you very much for that, Keith. I think it's interesting. The last 2 share talks we've done have been on coal and oil.
Yeah.
And in an environment where we don't want to use coal and oil ever again, and we have to continue to use coal and oil. And these markets are quite interesting from that point of view, having been highly unpopular, but nevertheless, they aren't going away anytime soon. So thank you very much for that presentation.
Yeah, the one thing I'd add to that, Richard, is you and I, we like to buy things which are where we see a value opportunity. And it's not because we, intentionally go out of our way to buy unethical products. It's because that's, in this case, that's where the opportunity may well lie. Whereas I think the green technology, ESG, those are all very strongly bid up, and we worry that they are overvalued currently. If we find one which looks interesting, we will be very keen to cover it. But right now, that's quite difficult.
I think that's right. They've all had such a significant uplift in their values over the last 6 months or so. It's very difficult to find one that you could consider to be good value at the moment.
Absolutely. So I hope you all enjoyed that. That will be the last oil services company we cover for a while. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.